So silver, the price will be more volatile. Gold is much more smooth in terms of how much it costs to get out of the ground and what the price will do. And the function is basically what is the cost of the largest 3 to 4 miners of gold in the world, plus the amount of money that's coming into passive investment in funds like GLD. Hey everybody, this is Rob Kientz from goldsilverpros.com doing a video report on behalf of JM Bullion. And today we're going to be talking about something that I wrote about on the JM Bullion blog earlier this week, and I highly encourage you guys to go take a look at it. And it has to do with the rising cost of energy and as an input cost, what that is doing to the mining sector in terms of their cost to mine and what that will eventually transmit into in terms of prices for the economy, but probably more importantly to you guys as bullion investors, what we'll do to gold and silver bullion. So without further ado, let's go ahead and jump into it. The first article I want to take a look at is from S&P Global Market Intelligence. This was printed back in March of this year, and they're talking about how the high energy prices are turning the metal supply chain into global inflation engine. Before I get into this in the next couple articles, I'm going to note that a lot of these articles are blaming Russia, Ukraine for rising energy prices. That's great because it did have an effect on energy prices, specifically natural gas and oil. However, energy prices have been rising for over a year. It's been in the commodity price data and in the CPI data, as well as the producer price indexes. I'm not going to show those for the previous year for this presentation because I've covered that before in previous reporting, but know that the Russia-Ukraine conflict did not start inflation in the economy or in the energy sector or in the metals that we're talking about today. It started beforehand, and that is factual information that we have covered before. That being said, let's get into it. It says here that some metal producers in less affected parts of the world, such as the US and Canada, benefit from relatively lower energy costs, but they may be unable to quickly compensate for decreased production from higher cost countries. Meaning, even if you're one of these advanced countries like the United States and you have advantage of having better energy prices, we don't produce a whole lot of stuff. So because we're not a manufacturing nation, we're going to pay higher prices anyway, because the countries that are paying higher prices are simply going to pass them on to us. So just because we had the advantage in having the world reserve currency and we're a service-based economy, a richer economy, doesn't mean we're not going to pay higher prices. They will come to us. Continuing with the article, mining companies may also be reluctant to expand amid sudden price surges due to the expensive years-long development process to grow production. The combined commodity and energy inflation is poised to diminish demand for metal-intensive consumer products and drive down global growth, analysts and companies said, although it may accelerate a move away from fossil fuels by some companies. And we see here, we're going to look at a few energy prices from this article. Henry Hub spot natural gas prices have gone up, dating back to earlier this year. Hard coking coal prices have gone up. Brent crude oil prices have gone up. And what you really want to know from this article is how much the cost of energy affects mining. So for mining in general, it's 15 to 20%. It says here, energy accounted for 15.8% of mined iron ore costs in 2021. And that proportion has been as high as 17.5% in the past decade, according to Commodity Insights data. A BHP Group Limited spokesperson confirmed to Commodity Insights that energy costs are increasing as a result of Russia's invasion of Ukraine, said the company is well positioned to manage them. It's also interesting from the article to note down here, energy accounts for 19 to 20% of copper mining costs, according to Commodity Insights data, and the industry will be spared some of the effects of rising energy prices when hydropower is a significant energy source. That may be never, because most places don't have hydropower. And as we see, the inputs into the clean energy movement, our input costs are rising because of rising energy prices, which is going to slow down what's going on with that. I'm sorry, we have this article twice. Let me move it on. We're going to go into a second article with the International Energy Administration, an article they wrote in May of 2022. Critical minerals threaten a decades-long trend of cost declines for clean energy technologies. So I'm just going to show a couple of charts, basically the same ones I put in the article at JM Bullion, that you can see for clean energy metals and minerals, the prices have risen substantially. Lithium has risen January 2021 to March 2022, 738%, cobalt 156%, nickel 94%, aluminum 76%, and copper 34%. Lithium-ion battery costs have come down. However, the cathode material costs have gone up 21.7%. And for the first time in 7 years, the cost trends for solar PV modules are to the higher side. So PV modules for solar had come down, but the rising energy costs are inflating that this year 16% year over year because of the inputs into solar panels. Same for wind turbines. For the first time in 7 years, wind turbines are getting more expensive. So we know that the energy costs for the inputs to building wind turbines and hydroelectric and solar, those metals and minerals are going up. So therefore, we cannot have clean energy take over fossil fuel energy anytime soon because it's simply going to cost more. Why? Because fossil fuels cost more, and they are the main input costs into getting the minerals that you need for clean energy. So you see, it's a little bit of a loop. So you cannot fight the rising cost of fossil fuels with clean energy because you need fossil fuels to build and to maintain and to continue clean energy. Clean energy is not self-sustainable at this time. It may or may not ever be, but right now it's not. Well, on top of that, now the Biden administration is calling for a windfall tax on oil. A lot of this has to do with previous tax cuts. We'll get into it. This is a Reuters article that came out November 1st. And we're going to talk about what they say here from Reuters. U.S. President Joe Biden on Monday called on oil and gas companies to use their record profits to lower costs for Americans. In remarks at the White House, Biden criticized major oil companies. The oil industry has not met its commitment to invest in America, so on and so forth. And he's calling for them to basically pay more. Warns Larry Summers this could backfire. If we go back to Reuters and an opinion piece, it could backfire because, according to Larry Summers, I'm not sure I understand the argument for a windfall profits tax on energy companies. If you reduce profitability, you will discourage investment, which is the opposite of our objective. The point I want to make here is if you make it more expensive for energy companies to operate, that will raise the cost for energy in the future because they're not going to explore and develop as much, which will raise the cost for everything in the economy. I'm not for or against taxes. I'm just simply saying what the two sides of the argument are. At the end of the day, it looks like if they do a windfall tax or any sort of tax on the energy industry, it's going to raise costs, reduce the amount of future exploration and output, and potentially raise prices across the board due to raising costs. Last article we're going to talk about today is from the World Gold Council, right here on gold.org. The title of the article is Rising Energy Prices Push AISC, which is all-in sustaining cost to mine an ounce of gold, to a record high in quarter 2 of 2022. It's written by Adam Webb, who's director of mine supply for Metals Focus. Metals Focus is the one that does the data for the Silver Institute that we quote basically every year when that report comes out in November. Should be a new one coming out this November. They're considered an industry leader in terms of data on gold and silver. He's pointing out here that the average cost, all-in sustaining cost, or the total cost it takes to get an ounce of gold out of the ground, has risen over the last 2 years from $1,000 to $1,300. That is a 30% increase. 30% increase, or 33%, he says, 18% year over year from last year, 33% in 2 years. That means that gold miners are making less profit. Less profit is less money for expansion, exploration, and development. It says here, input costs, including labor, fuel, electricity, and consumables, have been rising largely as a result of the COVID-19 pandemic and related supply chain disruptions. The next sentence is the most important, I think, in the article. However, the most significant driver of cost inflation last quarter was increased energy prices as a result of Russia's invasion of Ukraine. And as I will point out, costs have been increasing in gold because the cost of input into gold mining have been going up longer than the war has been going on. And we saw commodity prices start to increase over a year ago. So even though Russia-Ukraine has exacerbated the issue, that is not the only cause. It's certainly a big near-term cause. A longer long-term cause is that energy has been getting expensive for a very long time. I first wrote an article on this on Seeking Alpha about 10 years ago, showing that energy prices would rise and pulling information about what supplies we had both domestically and internationally for oil and for natural gas, and looking at that. And I called about 10 years ago, we're going to have rising energy prices and therefore rising prices in the economy. While the cost to mine gold has gone up 30% the last 2 years, the prices have not gone up nearly as much, meaning they're compressing margins. The top line and the bottom line are compressing down to each other, meaning the gold companies will have less profit. That is depicted in the last chart in this article. As you can see here, the profit has fallen. It went up during the pandemic, but then it fell back down. It was temporary. And so the AIC margins are compressing right now and have been doing so for about 2 years. And that raises concerns that the cost of mining gold and silver are going to continue to go up, which means those costs will eventually be transmitted to the end consumers who will pay more for gold and silver, which means the spot price has to rise. When will that happen, you ask? Well, the derivatives traders that do the paper trade on COMEX and in the London market need to get this information. They need to understand this information. They'll place their bets on the derivative trading, which will raise the spot price over time. But expect this to take time. The rising costs will have to go through the supply chain, come out the other side in terms of what the retail prices are, and then you'll see it rise. Why am I doing this report? Because I think the input costs for gold and silver mining are going to continue to go up. And our studies have shown that over time, that will force the prices of gold and silver to go up. It'll force gold more directly because gold is produced more out of primary gold mines than silver is out of primary silver mines. 72% of silver is produced as a byproduct of gold, lead, zinc, copper, tin mines, whereas more gold is produced primarily through gold mines. That means that silver price can be very elastic in either direction. It can either go down really low or up really high, and that doesn't affect the mines that are mining copper, gold, zinc, lead, tin that are producing silver as a byproduct, because they're not going to care about that. It's just a byproduct credit to what they're really mining, which is copper, gold, the other stuff. So silver, the price will be more volatile. Gold is much more smooth in terms of how much it costs to get out of the ground and what the price will do. And the function is basically, what is the cost of the largest 3 to 4 miners of gold in the world, plus the amount of money that's coming into passive investment in funds like GLD. Add those two together, and that is a mathematical function that will help you determine where the gold price is going. So you look at two things. You look at the cost of gold and silver out of the ground, and you look at the amount of investment going into gold as a passive monetary related investment. And those two factors will tell you whether gold is going to go up or down. We've seen pretty steady flows into GLD, although it's been a little bit of a sell-off this year as we've had liquidation across the market, which is why gold price and silver price have drifted down. However, with rising input costs and mining costs, that is the bigger driver of the future gold price, and we think that's going to push gold prices back up. This will be in the medium to long term, not in the short term. I still expect to consider some compressing prices in gold and silver until we get to the resolution of the December gold and silver contracts on COMEX and we reset for the new year. I do think the love trade in India, China is going to drive more physical demand. That's why we have such strong physical demand, which will put a floor into the gold and silver price. I don't think they're going to fall down to 12 or 1300 for gold or 10, $11 for silver. But I do think the marginal demand for gold and silver as an investment is going to determine where we go in 2023. With the Fed raising their Fed funds rate, with the input costs rising, inflation rising, the tightening of household budgets, and the geopolitical concerns in the economy, I think those are all bullish, for gold and silver to go up. But again, that information has to be reached to the derivative traders, which determine spot price. So just to reiterate, spot price has nothing to do with physical supply and demand. It has to do with futures trading and gambling in the market. Sometimes the spot price takes time to catch up to the information available in society, so derivative traders use it. So for right now, I expect sideways movement in gold and silver until we get a catalyst. This will be one of the long-term catalysts. A short-term catalyst could be bank failure or other like black swan in the economy. We'll stay tuned for that. This has been your report today from Gold Silver Pros for JM Bullion. Stay tuned as we'll do one of these every week and tell you the latest of what's going on in the gold and silver markets, the macroeconomic picture, and what you need to know as a gold and silver investor. Until next time, this has been Robert from Gold Silver Pros on behalf of JM Bullion.